Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about how to structure 1099 loans. Great topic to go through here, so we'll get into it in just a moment. Go ahead and drop a comment there in the chat as you tune in. You can also drop any questions you have in the chat as we go through the presentation here today. Give it just a moment here for everybody to jump on and go live on all the platforms. And it looks like we're good. So we'll go ahead and get it started. Again, drop any questions you have there in the chat, but we will go ahead and get into it. All right. So, welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our sales manager, Jose Gonzalez, and we are a lender that specializes in non QM loans. And what we do every Tuesday, Wednesday, Thursday evening at 7 p.m. Eastern on this show is go through a deep dive into a loan officer training topic. Tonight, we're going to be talking about how to structure 1099 borrower loan, something we're very familiar with here at the Mortgage Calculator because we do specialize in non QM loans. So, with that being said, I will go ahead and turn it over to Jose to take us through his presentation here.
Good evening, everybody. Thank you for joining us for tonight's presentation on 1099 borrowers. So, what exactly is a 1099? What is a 1099 borrower? Well, I'm not going to spill the beans. I'm not going to get ahead of myself here, and because all of those explanations are in my presentation. So, give me a second here and I will be ready to share. Okay. All right. Sorry about that. So let's jump right into it here. How to structure a 1099 borrower loan. So, what is a 1099, right? A 1099 is an IRS form that is issued to sole proprietors, independent contractors, partnerships, and LLCs. And here's the main point to consider for non employee compensation, right? In other words, you can't be an employee of a company and be receiving 1099s, right? 1099s are self employed borrowers only. Uh, a 1099 loan is a great alternative option instead of bank statement loans, and I'll get into that in a minute when I go over some of our sample guidelines that I have. Now, one thing to note for 1099s, now, for self employed borrowers, we always state that we need 2 years self employment in some cases, to verify that they've been in business for 2 years. However, with our 1099 options, we have options that are possible with less than 2 years of self employment. Now, how is this so? Well, you could have a 1099 borrower that previously worked for that same company as a W 2 employee, but is now working for them as an independent contractor. Or you could have a 1099 borrower that previously performed the same job duties as a W 2 employee, but is now doing it as an independent contractor. Now, it can be for the same company or it can be for another company, but the main note here is that they're doing the same job duties. For example, we have a loan right now where it's a doctor. He was right. You would never think about that, but remember, doctors are licensed. That's another key component here that helps with the 1099 loans. We have a doctor that was previously W 2 and now switched over to 1099. And he actually happened to switch over mid year. So keep that in your train of thought. And when I get to talking about the guidelines, I'll let you know how we were able to put that one together. Yes, you can have somebody actually less than 12 months and can do the 1099 loan. So, who qualifies for a 1099 loan? Well, I already made a mention. We're talking about self employed borrowers only. 1099 loans are perfect for realtors, right? All realtors get 1099s. U.S. citizens, permanent resident aliens, non permanent resident aliens with U.S. based credit and U.S. based income. Now, you will note foreign nationals are not allowed under a 1099 program because 1099s are based on income generated in the USA. If you receive a 1099, you had income from work that you did in the United States of America. And foreign national, by definition, is somebody is a citizen of another country who's deriving their income from another country, not from the U.S. They would, unless they have legal work authorization in the U.S., the foreign national would not be able to qualify under 1099. And if that foreign national did have work authorization in the U.S., guess what? They would be a non permanent resident alien. And then they would also need U.S. based credit as well as the U.S. based income. Please note that entity vesting is allowed on investment properties for 1099 loans. We'll be talking about common entities like LLCs, C Corp, S Corp, a partnership, limited partnership, to name the more common forms of entity ownership. Please also note that 1099 loans are eligible for primary, second home, or investment properties. Talking about properties, what would be our eligible properties and LTV? Well, 1099 loans are all done under the non QM loan category. Right? Uh, you would be looking at single family homes up to 90% max LTV, a PUD, which is a single family home in with a homeowners association. Could be a townhouse or it could be a detached single family homes. But PUD means that there's a homeowners association. We can 1099 loans are eligible for warrantable condos up to 90% max LTV. 2 unit properties also up to 90% LTV. 3 to 4 unit properties up to 85% LTV. Please note that modular homes are considered as long as they're not unique. Now, what is a modular home? A modular home is not a manufactured home. A modular home is a home where the pieces are built in the factory and then those individual pieces are transported. It could be pre-wired, pre-plumbing, all that kind of good stuff. And then those individual pieces are transported to the job site and they are assembled on the job site. But it is not a manufactured home. Non-warrantable condos up to 85% LTV. And we can even loan on rural properties up to 20 acres and up to 80% LTV for our 1099 loan options. Now, what are some of the credit and asset requirements for the 1099 loan? Well, we can actually go as low as 600 on the credit score at an 80% LTV with at least 2 trade line reporting in the past 24 months or 3 trade lines in the past 12 months. Please note that the best options for non QM are always going to be at a 660 or above credit score and preferably 3 trade lines reporting for 12 months or 2 trade lines for 24 months with activity in the past 12 months. As always, asset verification not required on cash out refis. For our 600 plus credit score option, we do need 48 months seasoning on credit events. With 24 months seasoning for the 600 or plus credit score option, but 48 months seasoning on credit events for the best case option. That would be like in some of our investors going between the super prime and the prime option, right? A, B, C, D. Now, 0 times 30, and this is on the mortgage, right? For the last 24 months is going to give you the best options, but we actually do have for a 1 times 120 in the past 12 months or C grade, we actually have 70% LTV. Now, I'm obviously not giving you every particular configuration here. What I'm doing is telling you that you got to have an open mind because there's a lot of different options out there if you vary the LTV. And now the reserve requirement is really going to vary depending on the investor, right? But it can be anywhere from 6 months for the best case select option down to no reserves at the lower LTV and credit grade. So typically, as they lower the LTV, they're going to get a little bit more lenient on the reserves. So let's go over here now, sample guideline here, so that we can break it down now, because I did touch on some points here, but I want to break them down line by line. So notice here, payments to sole proprietors or contract individuals are reported on IRS Form 1099. I already went over that, right? And included in the borrower's Schedule C. Now, this is really important to note that, the 1099 borrower hopefully will have a Schedule C, because if they're anything other, if they're incorporated or anything like that, it's not going to go under Schedule C. Now, you do not have to turn in tax returns for this program. Keep that in mind. As long as for this particular guidelines, you provide 1099s for the most recent 1 year. And in this particular option, it says 1099s are from the same single employer for the past 1 year. They're also telling you 1099s are validated with a wage and income transcript from the IRS. So, and actually, let me give you the last bullet points, and then I'm going to expand a little bit on, this is not cookie cutter here, right? Year to date earnings for the 1099 option need to be verified, and they can be verified by either a year to date pay stub. Now, keep in mind the pay stub is not going to have deductions, right? There aren't going to be any payroll deductions because this borrower is self-employed. They're not an employee. They'll be responsible for their own payroll expense when they file their tax return. So the year-to-date earnings can be verified by either a year-to-date pay stub, a written VOE from the 1099 provider. I'm not going to call them their employer because they're not an employee. I guess I could call them their contractor. The borrower is the independent contractor, and they are contracting the borrower. Or other equivalent third-party documentation. Now, what are we talking about there when we talk about or other equivalent third-party documentation? Well, most of the time, you probably will not have a 1099 borrower with a year-to-date pay stub. And if they have more than one employer, you may have an issue with the written VOE. But other third-party documentation could be, for example, from an accountant, from a CPA. If that employer or the company that's contracting them cannot provide a written VOE, maybe they have an accounting staff or a CPA that can provide a letter on the CPA letterhead stating the year-to-date earnings that have been paid out to that borrower. Now, the one thing to note, and I guess this probably could have been the number one bullet, but remember here they're stating in this particular guidelines these 5 bullet points are the bullet points that you would have to meet so that you do not have to provide the tax return. That's the whole point here, right? Tax return is probably going to have a lot of unreimbursed business expenses that will knock down our gross income. So in the last bullet point states here, all gross receipts will have an expense ratio of 10% applied to them. What that means is that you can get that 1099 document, and whatever is the gross amount, multiply it times 90%, and that's the borrower's income. Really, really easy. So let's assume that we're talking about $100,000 in a 1099. Well, then that's a really easy file, right? You don't have to go through 12 months of bank statements. You don't have to worry about declining income trends. You don't have to worry about large deposits that can't be sourced or documented. I mean, you're just looking at the gross amount of the 1099 times zero point 0.9. So in this case, our 1099 borrower that got issued a 1099 for $100,000 would have an income of $90,000. Now, this is why I was stating that it's a great program for realtors, and actually a great program for anybody that receives a 1099, because a 1099 loan will be much cleaner, a much cleaner file than a bank statement loan, with many less obstacles to overcome. For example, what are some of the obstacles that you could be facing with a bank statement loan, right? And we touched on them a couple of minutes ago. The first one is declining deposits, right? If you have declining deposits, that's a real big red flag that could cause a loan to be denied. If you have large deposits that can't be verified as income, then you're going to have other issues as well. If you have too many NSFs or overdrafts, and in most cases, having more than two or three in the last 12 months is going to disqualify the loan. So, those are some issues there that could affect you. Another issue with the bank statement is you haven't been in business for 12, for the amount of time. Typically for the bank statement loans, they're going to want 2 years. They may make the exception if 1 year under the same pretense, you were doing the same job duty as a licensed employee, like an electrician, for example, and now you transition to being a 1099 and electrician. Well, that's one way to do it. But again, that's an issue that you're going to have, where the 1099 is going to be a lot easier. I had made a mention to you all to hold on to the thought about the one loan that we're currently doing with a doctor, right? Great income, but halfway through 2023, the doctor transitioned from W-2 to 1099, right? So we actually have, for half of the year, we have a W-2 for 2023, and for the other half of the year, we have a 1099. And then we have about 6 months worth of income now via a 1099 that we were able to document with a year-to-date letter from the employer. So in that type of a scenario, since it's with the same company that previously hired him as an employee, and now they're hiring him as an independent contractor, and he had the W-2 and the 1099 from the previous year, he did receive a 1099. So we just added up the W-2 income and the 90% of the 1099 income to equal his 2023 income. And now we are further documenting that with the year to date 2024 income. So in that case, that's a great loan that was able to be put together with due to the fact that we are doing this as a 1099 loan. So notice what it says there. If the borrower does not meet the requirements above, tax returns for the most recent 1 year or IRS 1040s are required to determine income and related expenses. Now, one thing to note also is how the file will be quality control tested. You will be asked to provide wage and income transcripts, which is basically a W 2 and 1099 transcripts. They call it wage and income transcript as opposed to the record of account transcript, which is the transcript that is all inclusive and says, what you reported in net income and what your tax liability was, all those additional details. Whereas the wage transcript, which is for W 2 and 1099s only, will only list all the 1099s that you may have received in that calendar year, as well as all the W 2s that you may have received in that calendar year. It will not talk about your tax liability nor anything like that. And they will use it to just reconcile the amount listed on the 1099 document that was provided and make sure that it matches the 1099 that is in the IRS records to make sure that the documents were not altered. So that's really important. Now, if the wage and income transcript for whatever reason is not available, cannot be located, then you will probably have to provide tax returns anyhow and figure out an alternative method to verify the income. Notice it says here also on the guidelines, if the borrower is a seasonal 1099 employee, now look at this one closely, unemployment income compensation may also be used in qualification provided it can be documented with a 2-year history on Form 1099 and comments from the borrower's employer that the unemployment compensation is likely to continue as received. You do get 1099s for unemployment compensation as well. And notice it says here the unemployment compensation must be confirmed on the 1099 transcripts, which was what I was telling you, the wage and income transcript. Now, notice the note in the bottom, right? And they got the nice red box around it and all that stuff, which I had already made the point, is 1099 forms covering a full 1-year period are not required when a borrower changes from being paid W-2s to 1099s while working for the same employer in the same position. Now, that's a pretty cool guideline detail there. But I will note that these guidelines are for 1099 as well as all other um, income types. They're not homogeneous. And what I mean by that is they're going to change from option to option. In other words, from investor to investor. Are the investors in this case I'm referring to are the investors who we sell the loans to. So we have to review all the guidelines and make sure whoever's buying the loan, that we abide by their guidelines so that they will buy the loan, right? Simple as that. So with that being said, we have so many different companies that we sell loans to. That's why we have so many different guidelines, and we basically pick and choose the best one that meets the needs of the borrowers. So in this case here, it's stating 1099s for the most recent 1 year provided, and 1099s are from the same single employer for the past 1 year. But there are other guidelines out there that do not have that requirement of 1099s are from the same single employer for the past year. You could have multiple 1099s, right? Depending what you do. Now, most people that 1099 don't have multiple 1099s. They're usually going to be like the realtor or the doctor that's working as a 1099 employee, independent contractor. So you're going to be able to meet the guideline requirement in that case. Now, but again, that is not a requirement that's across the board the same for everyone. So some important points here to consider would be that basically the 90% point, needing to verify the year-to-date ending earnings, and saying how long they've, if they've been with that particular 1099 provider. I mean, I don't, they refer to it as employer, so we'll keep referring to it as employer, but just keep in mind that they are not employees, right? They are independent contractors. And I did mention earlier that due to the fact that this is U.S. based income, then we would not have any foreign nationals that would be applicable for 1099 loans. So again, 1099 loans are probably going to be the easiest loan that you're going to do in the non-QM loans, because it's not like the bank statement loan that you gotta put 12 or be using 24 months worth of bank statements on an Excel spreadsheet. Then you got to look at deposits that you have to back out because they're not income related, or because they're transfers or credits or whatever it may be. um, so it's your income can vary quite a bit on a bank statement loan depending on who's reviewing the deposits. Whereas the 1099 loan, again, is very cut and dry. Typically, it's going to be 90% of the gross amount of the 1099 is what will be considered as the income for the borrower. So definitely look to the mortgage calculator for all your 1099 loans, as well as all your other alternative income loans. Did mention bank statements, did mention profit and loss, and if I would have put it in a pecking order, I would probably would put full doc as the first option, then 1099, then bank statement, then profit and loss, then asset utilization, and then if it's an investment property, DSCR.
All right, thank you, Jose. Great presentation there. Let's see here. Some questions. Question is it possible bank statement scenario better than 1099?
Well, I think I just explained that. Usually it's the other way around. Now, I guess what I'm talking about is in terms of the simplicity of the transaction, right? That's what I'm talking about, a cleaner file. Um, Interest rate wise, they're all very similar. Now, you may have in some cases where you could find a better option for a bank statement, interest rate wise, maybe a less expensive option for a bank statement loan than a 1099 loan. I'm not going to say there aren't going to be cases of that, but usually they're the same. I mean, they're very similar rates. There isn't like a big discrepancy. Where you're going to find a little bit of a more difference is when you're comparing 1099 or bank statements to profit and loss, because profit and loss loans have a little bit less liquidity in secondary, so it's just going to be a little bit more expensive.
All right, let's see here. Is this exclusive for non-QM loans? So I guess it'd be a good time to just touch on officially what makes a loan non-QM, Jose. What is a non-QM loan?
Well, not. I mean, we have agency loans, right, which are conventional loans or FHA loans, um, USDA and VA. Right? Those are all full doc. Those are all sold into the secondary market via to the different agencies, the GSEs, Fannie Mae, Freddie Mac, and Ginnie Mae, which is the buyer of the government loans, right? The USDA and the VA, excuse me, just the FHA loans. VA, they go to Ginnie Mae. So those are agencies. Those are the ones that we consider more the QM loans. The non-QM are the loans that don't sell through the agency portals to the Fannie or Freddie. They're independent individual guidelines. The loans are sold to investors, usually Wall Street investors, hedge funds, insurance companies that buy up these loan portfolios to generate income, right? So they're not your agency loans, which is typically what's going to make them non-QM. More than anything else is going to be that. Now there are some other differences in the non-QM loans, right? They're all manually underwritten. There's no automated underwriting ever for a non-QM loan, and and again, the fact of being non-QM is what gives us so much variety, because they're not bound by the same guidelines that everybody else has to be bound by. So everybody that does Fannie Mae loans has to abide by the Fannie Mae guidelines. There may be overlays, which are some additional restrictions that the investor, buyer of the loans, investor may add, but the guidelines overall are going to be the same, just additional restrictions added. You can't loosen it up more than it already is. So that's another thing to consider between the QM loans and the non-QM loans. And yes, the 1099 option is only for non-QM loans.
And here's a question: 1099 brokered loan. Well, we would do our 1099s where correspondent where we are the lender. Maybe there's some crazy guideline where you'd need to do it brokered, but for the most part, we would be the lender for those.
Absolutely. We're going to have usually the best pricing on all of our loan options when we're the lender. We, like Kyle mentioned, we use the broker channel for those outlier programs that we may not be able to have an option for, like a 575 credit score and a DSCR purchase or cash out. That option we can only originate brokered, as an example.
All right, and it looks like probably the last question here: are these loan apps taken using a 1003 essentially?
Absolutely, yeah. This is not like a skinny app that you may find for some of the business purpose loans. This does use the standard 1003. We do use in our case. I mean, most of the all the lenders are going to use Encompass for their loans and generate the ERLA via Encompass, the 1003.
All right. Well, great presentation there, Jose. I don't see any more questions. So I think we'll go ahead and wrap it up. Remember, we do this at 7 p.m. Eastern Time every Tuesday, Wednesday, and Thursday evening. So we will see you all tomorrow, 7 p.m. Eastern, for the next episode